this next presenter plays into the battery metals EV revolution that's happening and how we're consuming electricity. And it's going into lithium. But before I talk about lithium or anything, Michael Beck is here from LSC Lithium, who's presenting. Michael's last venture in the last uranium bull market had him and his business partner owning around 10% between him and his partner, exiting a company called Euromin for $2.5 billion. That guy over there. So I think I've warmed them up as best as I can, Mike. This is your job now. So let's do it.
About what I think is the most interesting development in our industry, the mining industry, since the early mid-2000s, which was, as some of you that were around then remember, the China-driven supercycle, and specifically the electric vehicle revolution and its implications to the metals market, because I don't think it's fully appreciated yet, and so my objective is really to let the numbers speak for themselves, and I think you'll come to the same conclusion that we have, that the implications on a select group of metals are in fact very dramatic. It's being driven by three different forces. The first is regulatory, and here you see a chart that I took from Vali, and they took it from somebody else, but it's CO2 emission standards that have been mandated across 4 different jurisdictions between now and 2025. And the trend line is unmistakable, and the only way that vehicle manufacturers can achieve the fleet mandated CO2 standards that are being lowered every year in every jurisdiction is by increasing the mix of zero emission vehicles as part of their fleet. And if anything, this trend is going to, I think, surprise on the upside. You have recent announcements, for example, you may have seen in the FT, to the extent it's meaningful, that France has banned ICEs, internal combustion engines, from 2040 on. But more to the point and more in the near term, China announced 2 weeks ago that next year 8% of new passenger vehicle cars must be electric or zero emission, and in 2019, 12%. And then you have California, which mandated in May that come 2025, something like 25% of every manufacturer's new car sales in the state of California have to be electric vehicles. So this is a trend, and it's accelerating, and it's not going to go away. And so that's one push, and that's one part of the dynamic, but perhaps the more important and compelling driver is economics. And this is a plot of crossover point by jurisdiction for when an electric vehicle, an EV, becomes cheaper to own and operate than an ICE. And these projections were derived from a Bank of America report on the subject last month. But so, for example, using their assumptions, by 2022, it will be cheaper to purchase and operate a diesel passenger vehicle in Europe as an electric vehicle, cheaper as an ICE than a diesel. The next year, it will be cheaper to have an electric vehicle than an ICE in Europe. The US, where gas prices are lower, it's 2023, and so on. Again, I think that these projections are going to surprise on the upside. There was a report from UBS last week that actually projected that the crossover point for cost parity in Europe would occur next year. That by next year, because of rapid improving price performance of batteries, that it will be cheaper to purchase, own, and operate an electric vehicle than it will an ICE. And so this is pretty compelling. When these crossover points are achieved, and the only question, it's not will they, it's when will they? Will it be 12 months from now, or will it be 36 months? But at that point, it makes no sense for you as a consumer to purchase an ICE when there's an electric vehicle equivalent that is going to cost you less to purchase and operate. And you see this just in vehicle offerings. You may have seen the announcement last month that Volvo is ceasing the production of all ICEs come 2019, and from 2019 onward, they will only offer electric vehicles. GM announced also a month ago that come 2023, all of their vehicle offerings will be available both in electric and in ICE. Volkswagen announced a target that 25% of worldwide sales of their fleet will be electric vehicle. So it's now there's a third driving force, which is from the manufacturer's perspective. It's actually for the manufacturer. It's a lot cheaper to construct a plant to build electric vehicles than it is an internal combustion engine. It requires half the factory footprint, half the capital. It represents a 30% improvement on assembly productivity, and it's a lot more flexible and scalable. So the manufacturer has a major incentive to do the crossover because it's cheaper and faster. The consumer soon will have an unassailable economic equation in favor of electric vehicles, and then you, as if that's not enough, you have the regulatory push to drive emission standards lower. And the only way those emission standards can be achieved is through electric vehicles. So what does this mean? It means that the passenger vehicle market is going to go from today, which is 1% of passenger vehicle sales, to something on the order of, pick a number, the consensus estimate is 15 to 20% of passenger vehicle sales by 2025, and that certainly by 2035, the majority of passenger vehicle sales worldwide will be electric and not ICE. So what are the implications for the metals business? Well, depending on which battery chemistry is used, they all consume, with the exception of aluminum, copious amounts of nickel, cobalt, and lithium. I put aluminum up on the slide because it's used in one of the battery chemistries, NCA, but its impact on incremental demand relative to the size of the aluminum market is not dramatic. So I'm going to focus in this presentation on the other three metals, lithium, cobalt, and nickel. So let's start with lithium. Lithium, it's a niche metal. The size of the market is about 200,000 tons a year. That's total mine supply. Just to put that in perspective, that's about 1% volumetrically of the size of the copper market. If you look, you see in the lower left-hand table are LCE, that's lithium carbonate equivalent requirements for various vehicle types. If you look, for example, at the Tesla Model S and the 70 kilowatt hour offering, which is at the low end of their spectrum, that requires 63 kilograms of LCE to produce. By the way, on average, the battery pack is 40% of the cost of an electric vehicle. So what does that mean in terms of demand? That's really shown on the right-hand side, the slide there. And so the current total mine supply is 200,000 tons a year. If you assume that electric vehicle penetration will be 15% of passenger vehicle sales the world is going to need 4 times current world mine supply. If you assume 25% EV penetration or adoption, the world's going to need 6 times current mine supply. And if you assume that all passenger vehicle sales are EVs, then the world's going to need 25 times current mine supply. And if we just focus on, let's say, the 15% figure, which is sort of the bottom end of the consensus estimate for EV penetration by 2025, that's a pretty tall order for total mine supply in the next 8 years to grow by 4x. Particularly, the lead time for a new hard rock lithium mine is typically 5 years. For the preferred source, which is lithium brine, is more on the order of 7 years. And the typical mine is sized at 20,000 tons a year. So what that's telling the market is that not only will massive capital have to flow into this sector to build new capacity, but it's going to be a challenge to deliver enough product, and you see that already. Lithium carbonate prices have gone from where they traditionally have traded, which is $5,000 a ton, to, well, just last week, cargoes were trading in China at $28,000 a ton, and it's probably on its way to $100,000 a ton. This material has a high degree of price inelasticity. So at $10,000 a ton, it represents 1% of the final sticker price of a car. So if you have to pay $50,000 or 5 times that or 10 times that, you'll pay it. It won't destroy demand, and it can be absorbed by a combination of the supply chain and also the consumer. And so in that sense, it's a little bit like uranium. It has a high degree of price inelasticity. So that's lithium. So it's rather dramatic. I've been very involved in the lithium space the last 2 years, and I scratch my head and wonder how the industry can possibly deliver these incremental volumes. There will be shortages for sure. And shortages mean higher prices, and so even if you're not a believer in the EV or lithium story, one thing's for sure, you don't want to be short the metal for the next 3 to 7 years, because it won't be a good place. Cobalt. Cobalt is interesting. It's a niche metal like lithium. It's the total mine supply is 100,000 tons a year, so it's half the size of the lithium market, and it's to put that in the context of copper, it's 0.5% volumetrically of the copper market. So it's a niche metal. The demand profile based on an EV penetration rate of 25% by 2025 says that the world's going to need something on the order of 450,000 tons, or 4.5 times total mine supply. That's a particularly big ask for cobalt, since there is really no such thing, with 1 or 2 exceptions, of a cobalt mine. Cobalt, 99% of cobalt is produced as a byproduct of either nickel or copper, and only select nickel and copper styles of mineralization. So if you need more cobalt, it's not like lithium where you can go out and build a new cobalt mine. You have to increase production of nickel, or you have to increase production of copper. And add to that 60% of the world's cobalt comes from the Congo. That introduces another element of challenge in the supply chain. So cobalt is very interesting. The price has gone from $10 a pound in the last 12 months to $30 a pound, and in my humble estimation, on its way to in excess of $100 a pound. The challenge is, how do you get exposure to the metal? Because there really isn't, well, there's one pure play, which I'll talk about, but otherwise the biggest producer is Glencore, but it's a tiny part of their product portfolio. So it's very interesting metal. There's no doubt it's going up, and it's going up fast, and I wouldn't be surprised. There are physical shortages already in the marketplace that, and it's highly price inelastic for most of its end uses. So people, if they have to pay $100 a pound, they'll pay $100 a pound, and it won't destroy demand. So that's cobalt. Nickel is nickel's a little bit of a different story. These are internal projections from Vali that were kindly given to me by my friend who heads up the business intelligence unit at Vali. So he and his team sit around all day and they think about this stuff. It mirrors our own internal analysis as well, because we've been looking at this for some time. Nickel is a much bigger, substantial metal market in terms of volume. The total mine supply is 2 million tons, so that's 10 times the size of the lithium market, and it's 20 times the size of the cobalt market, but it's still only 10% the size of king copper. This is really interesting, and I don't think, while the investor community is already well onto the lithium and the cobalt story, I don't think they've quite yet appreciated the implications of electrical vehicle adoption on nickel demand. And this chart is interesting, because what this chart shows is for an assumed 25% EV penetration rate, what is the incremental demand that will be generated for nickel? Because all of these battery chemistries use nickel, cobalt, and lithium, but they use mostly nickel. So by weight, nickel is the most important. The chart shows at a 25, which is the end year in 2030, at a 25% penetration rate, the market's going to need 2 million tons of incremental nickel. So that's the entire mine supply today has to be doubled. Oh, but wait, it's even more interesting than that, because for battery usage, you can only use class 1 nickel. There are two forms of nickel. You have class 1 nickel and class 2. Class 2 is NPI, nickel pig iron, and ferrous nickel that can only be used for dirtier applications or the low end of stainless steel. But for batteries, you need class 1. The total production of class 1 nickel today is 1 million tons. So what this chart is telling us is that if you assume electric vehicles are 25% of the passenger vehicle market by 2030, you're going to need a trebling of class 1 nickel production. And nickel is interesting because it's by far has the highest capital intensity. So to bring a new ton of annual production capacity, you have to spend anywhere from $50,000 to $120,000 per annual ton of production capacity. Compare that to copper, which is more on the order of $20,000 to $40,000 a ton. So it's by far the most capital intensive metal. And so I asked my friend, I had dinner with him at the Cathode conference. I said, so how are you going to, at Vali, how are you guys going to do this? You're the largest nickel producer in the world. And he said, we can't. There's no way that they and the industry, in their humble opinion, can deliver in the next 12 years, maybe in the next 15 or 20 years, but 2 million additional tons of class 1 nickel supply. They would have to start breaking ground today. And the nickel price is still beaten up. It's $5 a pound, $5.30 a pound. And the incentive price for new nickel production capacity is probably on the order of $8 to $10 a pound. So watch this space. Nickel is going to make, my prediction, a major move in the next 6 to 12 months. And so this is, as an investor, this is a good time to be positioned. I'll show you another internal Vale chart. This is sort of this is their internal supply-demand balance forecast. So this has, the green is their sort of conservative case for EV penetration. The red is the 25% penetration by 2030 case. And am I running out of time? 5 minutes. Okay, I'm almost done. So it shows that the market's going to be in deficit 2 million tons by 2030. And again, that's class 1 nickel. So let me just wrap up. So how have I played this? Because the last 2 years I've been, with my partner Stephen Tuttel's been looking exclusively at this battery thematic. So on lithium, we own a company called LSE Lithium, which was IPO'd in February of this year, has a market cap of 150 or 160 million. The reason why we like it, it has the largest resource base of lithium brine, which is the preferred feedstock source in the world. It happens to be in Argentina, in the lithium triangle. For us, it represents massive levered exposure to the metal. So as the metal goes up, this will go up. Cobalt, as I mentioned, is a difficult one because, oops, I skipped over it. Okay, cobalt. So, because there aren't really any pure plays, there's maybe something like e-cobalt or something. So this is a pure cobalt play, which was IPO'd in June or July, $230 million. It's interesting because it's underpinned by $200 million of physical metal. So it's kind of like a cobalt ETF. They went out the prior 18 months, bought every scrap of bit of cobalt they could find, and when they couldn't find any more, they IPO'd it. So it has a market cap of $230 million, underpinned by $200 million of cobalt ingots sitting in warehouses in Baltimore, Rotterdam, and Shanghai. And they're now doing streaming deals with the likes of Vale and others that will give additional leverage to the play. So this is going to move up and down with the cobalt price. And finally, maybe the most asymmetric risk-reward play that we've seen in a long time. I listened when Eric talked this morning, and we, like him, like to find stuff that has a 20x upside and only a 50% downside. And in the nickel space, this is it. It's the most mispriced nickel asset in the market. It's called Giga Metals. It has a market cap of 14 million Canadian dollars. And it used to have a market cap of $150 million in the last nickel boom. Nothing's changed except the nickel price. It owns the second largest undeveloped nickel cobalt sulfide deposit in the world, happens to be in British Columbia. And its nickel sulfide deposits produce class 1 nickel, which is what you want. And it's cheap, and when the nickel price starts to move, this thing, if nickel goes back to 10 bucks, I guarantee you this stock is going back to a market cap of at least $200 million. So it's a 10 to 15x if the nickel price moves, and my thesis is right. So I'm out of time, and thank you very much. At the Cathode Metals Conference in Newport Beach, Sunday, Monday, Tuesday of last week, everybody interested in battery technology, mostly the battery makers, the manufacturers that use it, and also the raw material suppliers, including the cathode makers, were there. And so most of the talks were on battery chemistry. And what's happening now is that the principal technologies are NCA, nickel, cobalt, aluminum. That's what Tesla uses. And the rest of the industry, except the Chinese, are using lithium on phosphate, but that's being phased out, are going, the rest of the industry is going to what's called NMC. And a lot of them are already there, nickel, manganese, cobalt. And what's happening is the most popular chemistry now is a 5-3-2 chemistry, so 5 parts nickel, 3 part manganese, 2 part cobalt, and the industry is now moving to, gradually, because there's still some technical challenges, to an 8-1-1. And that's 8 parts nickel, 1 part manganese, and 1 part cobalt. And they want to get the cobalt down for cost reasons, and they also recognize the supply problem with cobalt. But also, cobalt doesn't do anything for a battery in terms of performance. The only thing it does is it inhibits and mitigates thermal runaway, thermal instability. So if you can substitute a part of nickel for a part of cobalt, then nickel actually contributes to battery performance in terms of storage density. You gain in performance and you lower cost. So the chemistry change that you refer to is coming, but the chemistry change for the next 3 to 7 years is just going to be to move toward an 811. The new battery chemistries that you read about weekly that are being cooked up at Stanford University or Waterloo or Oxford, or these will take, if you talk to people that are actually in the industry, at best 10 years before they ever see the light of day. Because first they have to be proven, then they have to be adopted by the industry, then the supply chain has to retool. And all these gigafactories that are being built around the world now as we speak, not just Tesla, but by the Chinese battery makers, Panasonic, LG, Volkswagen, they're all based on lithium-ion chemistries and NMC. I don't know if that answers your question, but yes?
Where do you think vanadium comes into play in the labor?
Vanadium is interesting. It's a little harder to figure out. We've looked at vanadium, and we're not quite, well, it's not that we're not sure that we fully understand the market dynamics yet, which is why we haven't taken a position, and we're still thinking on it. It's a little bit, because most of the vanadium is used as an alloying agent in steel, so it's not clear. And also vanadium will never work because it's a heavy metal, even though it has a high energy density. It will never work for electric vehicles or anything that needs to be light. It's possible there are some vanadium redox battery technologies that could work conceivably for stationary, like grid storage applications. But the industry has not adopted them, and there is another camp that suggests that the lithium-ion chemistry is becoming, since 2010, price performance improvements in lithium-ion chemistry have been year on year on the order of 18%. So there's a school of thought that vanadium redox battery technology will never make it out because it'll get eclipsed by lithium-ion. And by the way, I should mention all of my demand forecasts on lithium, cobalt, and nickel assume zero demand from grid storage applications, zero demand from commercial vehicles, zero demand from buses. So you'll have to layer all that into the calculation that was just based on electric vehicles, passenger vehicles. So, yes?
How important, economically speaking, is the cobalt deposit in gigametals project? The cobalt.
It's part and parcel. It's a nickel cobalt sulfide ore body, so they come together. And how important they are in the, well, I'll put it this way. In terms of the company did a pre-feasibility study and a PEA that was issued in 2011, and then the nickel price collapsed, and its share price collapsed and stopped working on the project. So at the time, the project was modeled as 27 years, producing on average 44,000 tons per year of nickel and 2,500 tons per year of cobalt. And if you do the math, the cobalt was about 10% of the revenue stream. So it's important because 2,500 tons of cobalt today is 2.5% of the cobalt market. So, yes.
What's the grade of this giga deposit, and what's kind of its break-even price?
Okay, so the grade is, it's a good news, bad news thing. You never get all good news in the same package, especially at this market cap. So the section that's been drilled off it's open pit, it's low strip from surface down. It's 1.5 billion tons, grading 0.22% nickel and 0.13% cobalt. 0.013% cobalt. The economics when they were run in 2011 at an 8% discount rate assumed a cobalt price of $14 a pound and a nickel price of $7.50 a pound, and a capex for development of $1.4 billion, and the NPV was $725 million. So the break-even price, unless capital costs have changed, would be about $8, $7.50, $8 nickel.
One last question.
Yes.
How do the material prices in terms of escalation because of the demand-supply situation? How does that translate into the retail price of the vehicle?
Well, in the case of, luckily for all of us as consumers and all of us who live on planet Earth and have to be concerned about global warming to a degree, or just having a cleaner vehicle, not spewing stuff in the atmosphere, these are relatively price inelastic. So if you, for example, if the cobalt and lithium and nickel price today quadruples, then the cost knock-on effect to the list price would be about 20%. So it's absorbable. And by the way, that'll be mitigated by improvements in performance, because every year the batteries are getting more efficient, having to use less metal, substituting out some of the cobalt for cheaper nickel, and so that's also going on in the background, which will help. From the conference last week, the cathode, and these were the chemistry guys and the battery chemistry guys, that for the next 10 years, it's lithium-ion chemistries will dominate. There is nothing in the foreseeable future that can be introduced on a commercial scale that can replace, and lithium will never be replaced because it is the lightest, highest energy density metal on the periodic table, with the exception of helium, and helium has other issues. So unless somebody missed, part of the periodic table the last 200 years, lithium is going to be there. And nickel also has certain unique attributes that are likely to make it irreplaceable in battery chemistries. If there's one of the metals that may get substituted out, not in the next 3 to 5 years, it would be cobalt, because cobalt, again, doesn't contribute to the performance, it just contributes to thermal stability, because that's the big risk. Is because when you buy, I'll just pick a Tesla S because they seem to be in the press all the time, but when you buy a Tesla S, and some of you I'm sure have one, well, what you're sitting on is, you're not sitting on just one battery pack, you're sitting on a battery pack that's made up of 7,362 little cells. And if you have a thermal instability with one of the cells, you have to somehow compartmentalize to make sure it doesn't become a fireball, like the Samsung was it Galaxy? Yeah, poof. So the Samsung problem was very specific. It was twofold. The engineers at Samsung upped the voltage, thinking they could get more juice and better performance, and they cut back on the lithium, and they got caught out. And everybody learned a lesson that you better not roll out a new chemistry unless you're 100% certain that you're not going to have thermal instability problems, because that's the problem. Yeah.
With projections you gave and the demand foreseen coming up, you've got a company like Tesla that has a new footprint, small production area, reduced footprint. They own the battery company. They make their own batteries, and they can't make a profit. And what you're saying is that the material cost is going to be in short supply. Those costs are going to go up astronomically. So I would think that shorting a company that's never made any money going forward would be a good bet.
I think you have to be careful, because the reason I think Tesla is not profitable is because of scale. And they're producing sub 100,000 vehicles today. But when the Model 3 snafus on production get straightened out, and they will. Their production will go from 100,000 vehicles to 600,000 vehicles, and then I have no idea what else they'll be rolling out. So in the case of Tesla, it's simply scale. No car company in the world, maybe with the exception of Lamborghini and Ferrari, can make money by producing less than 100,000 vehicles a year. So yeah, Tesla, and a lot of people say Tesla, and there's an argument that Tesla is not really a car company, that it's really a cloud storage company, because eventually the industry is going to go to fully autonomous, and this is a whole nother discussion, but Tesla has a big jump because you know, when you're driving your Tesla, it's uploading real time every move, and the deep learning algorithms that Tesla have are getting smarter and better, and at the end of the day, it's not about the vehicle, it's about the algorithms and what you do with that data.
So myself, like I was an exploration geologist, started out in the nickel exploration industry at $22 a pound nickel, and that was back in 2004, 2005.
Yeah.
And very quickly, I mean, we spent a lot of money, drilled a lot of holes, very active. It was a Falcon Bridge exploration team, and nickel price tanked down to $9, and I was without a job in the nickel space. And now nickel's $5. It's never really bounced back. It toyed with $8 back in Pine Tree days, which would have been 2013.
Actually, it went to it went to 26 in dollars in 2007, 2008.
Okay.
Yeah.
But long and short of it, it's been a very, very long and drawn out bear market in the nickel space.
For sure.
And it's been a pretty heavy squeeze on operators, and a lot of projects got mothballed and or shut down.
Yes.
Now, one thing you mentioned with Giga, which is I'm really optimistic, I'm very bullish on nickel, have been for a while. But one thing you mentioned.
Maybe you get your old job back.
Yeah, exactly. One thing you mentioned is that, you know, project throws off 10%. If it goes to production, the project throws off 10% of the market share, or market supply, current market supply of cobalt. I mean, if we were to envision, and we're all very bullish on cobalt right now, we're envisioning nickel prices to surge and a lot of projects to switch back on. Wouldn't that be flooding the market with byproduct cobalt from the increased nickel production?
No, well, remember, so the revenue mix, which is not unusual for this nickel cobalt sulfide project and others that are actually in production, like some of the ex-Inco, now Vale, is typically 95% of the revenue stream is from the nickel and 5% is from the cobalt, where that mineralization exists. So even if cobalt goes to $100, which I think it will, if you're sitting there as a nickel producer, nickel's $6 a pound, you're not gonna ramp up production just to get more cobalt units.
But if the inverse happens and the nickel price goes to $8 or $9, and some of these mega nickel projects fire back up again and start spitting off cobalt as
yes.
a byproduct, would that?
You guys need a bar stool, okay?
Yes, exactly. I think we'll take it up tonight at the bar.
Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be? It actually could be quite violent. It could be a rip your face off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?